Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shubh, and together with my partner and co host Patrick, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all.
All right, second time's the charm. Back to you and me, Patrick. Right? Um, Interesting set of questions, I guess we intend to get into this episode.
What do you got?
So, what I'm seeing here is some aspects or features of construction tech businesses that we like. I presume this doesn't necessarily have to be firms you have backed, it could be just firms we admire. Some M&A results, or I think you did some work. We have some anecdotes perhaps from our portfolio on, I guess, a bit of a wish list of what firms look for, when they go out and try to do a bit of M&A action and what they want to get out of that. And I guess it's a chat that all of us seem to have all the time. Like, how has the VC business been going in the last 3 months?
Nice.
Right?
That makes for a rich discussion.
Yeah. Any favorites on where we should start from?
I mean, let's start with the ConstructionTech business features that we've liked over the years. I think it's always. I actually don't think we've discussed that recently, so that's quite refreshing.
Yeah, I think so too. I mean, I remember 2 years ago, give or take, when we had a different version of our podcast, right? A very different version, I have to say, where we claim to disagree all the time, but somehow we always seem to agree a whole lot.
Somehow you always agreed with me.
Exactly. Right? So we had this discussion, which I certainly enjoyed a lot, which is saying a lot, about how we look for businesses which are very service rich, almost seem to have a very different interpretation of the very traditional VC 101 interpretation of a software company, or no assets, no services, just tech, tech, tech. And I wonder, 2 years down the line, how do you feel about that as an approach to looking at firms in construction tech?
What does service reach even mean? I know that VCs are great at inventing terms, and to your credit, you actually invented that term for me. So what does service reach even mean in the context of a construction tech startup?
So what I was thinking of was firms where, in a weird way, your positioning or your unfair advantage or your moat or something as basic as your value proposition to your clients is not the actual product that you offer. It's the fact that you represent like a peaceful resolution to solutions. So you're like, it could be something as basic as you represent the warm body they can catch to find the answer to their questions, right? It could be as basic as that. And to solve that problem, you're prepared to maybe offer very traditional looking services as solutions. So for example, if you're selling products, you offer a whole bunch of other things to make sure the service, the delivery is on time, the products are of high quality.
I see.
There's no anxiety with respect to whether deliveries are going to happen, right? So you have a person making sure, acting as a bit of a project manager. I think either in that episode or in another episode, I recall also using the term project management as a service, right? Which frankly is just another version of you saying service rich in my mind. It's more or less boils down to the same thing. You're just offering a whole bunch of other stuff, which it's hard to quantify through a specific product or a specific piece of tech, but you capture all the other enabling pieces of the offering needed for the customer's peace of mind.
Got it. Okay, so we're discussing this in the context of what kinds of different features we're liking about construction tech startups. So being service rich is one of the features that you're throwing in the ring. I agree, and I think the learning of the last 5.5 years of Foundamental has always been that construction is an outcome industry. It's always about the outcome. If you pay for a wall, the outcome is the wall. You don't pay for anything in the process in between. You got to put the wall in, and you do it under constraints. There's a deadline, there's a certain number of resources that you have specifically budgeted in your quote for this specific project to be done. And you have a workforce. Oftentimes you have too few workforce, and sometimes you have too much workforce just in a short stretch of time where you want to keep them utilized. So and then there's externalities like weather and all that stuff. So you're really under a lot of constraints that you want to deliver this outcome. So that's why I think companies that startups specifically that historically maybe in the very, very, very early years of construction tech have tried to do the traditional software as a service approach that did not encapsulate the services to deliver an outcome, they struggled because these SaaS businesses oftentimes come with training, they come with onboarding, they maybe need certain integrations into infrastructure, etc., and none of which solves the outcome here and now. It doesn't build the wall. So I do think that as an industry, construction, the construction value chains, etc., we are becoming more and more digital. So I do think a path to very traditional SaaS companies is becoming easier. And of course, there are examples which have mastered that, but far and few between. But until we're there, the service richness to get to an actual outcome is a feature that I really, really like. You see that a lot in marketplaces. Especially I think in emerging markets, but even the ones that work quite well in Europe and US have these service aspects. And even for software companies, I'm sharing the board with one of the world's most renowned vertical SaaS investors. And I found quite insightful what they said in this board. This is an SMB, software as a service company. They shared an example. Hey, don't shy away from monetizing training if it's needed, or monetizing an onboarding fee, an activation fee, because there are companies in this particular investor's portfolio where these one-off cash flows in the first 2 years actually by far outperform the ARR, and you can recover a lot of customer acquisition costs. That way you can make your business really cash flow positive if that's what you do. And construction as an industry is perfect for that.
Yeah, I mean, it also, I think, boils down to also the very human aspect, right? So if you have a service component, either as a SaaS company or as a product procurement player or anything else around, I think it also involves there being some aspect of a human connection or some sort of a connection between teams or some sort of dependency therein. And I know conventional VC thinking is, hey, that obviously makes the business either completely unscalable, or what is the path to disproportionate returns if that's a source of an unfair advantage. In fact, in most of the decks, of course, that you and I receive, that would be cited as one of the things being disrupted, quote unquote disrupted, right? I find that fascinating because many a time, and I think both you and I have done this, many a time we think of the truly transformative companies that we're seeing now in construction as having tech just connect pieces of services or other software, other products, just connecting them. But the core is still services or something else bringing it together. Tech is just a connector rather than the be all end all of the value proposition.
I'll give you an example. I've been recently interacting a lot with one of my portfolio companies in the robotics space. This is on-site robotics for construction side. They automate certain things on the construction side. It's a little bit in semi-stealth, so let me not go too much into depth here, but if you Google, you'll find it. And so this robot will always need some form of human interaction, even if it's just in the form of supervision, right? A supervisor on the construction site that looks at this particular type of work can oversee 5 to 7 robots at a time. Huge automation advantage, but there is that element of interaction. And also, there will always probably be a human actually doing the final quality assurance of this work, right? So to your point, there is that human interaction. And the service or the outcome is what I put in place, right? So that's what's being paid for. You don't pay for the robot. Sorry, you don't pay for the training on the robot. You actually pay for the thing being put in place. And what you're replacing is, 100,000 people in this job that are just not there, that we just don't have. But the interaction with the human is going to be there.
Yeah, absolutely. I mean, What other aspects do you think over the years we have grown to like, specifically about businesses that we think will do well in construction or have done well in construction in the last few years?
So something maybe a bit more about the founders, but I really appreciate founders that can discover extremely quickly, not at the desk, but going out and discovering quickly has so many advantages to the business, and it's really a muscle you want to train because it allows you to find things that your competition maybe doesn't know, hasn't found, and codify it into your own secret sauce. It allows you to identify risk, eliminate risk. It allows you to find opportunities, etc. All of that. But really what it does is it creates optionality. And the one thing that, if you think about this conceptually, right? So a VC builds a portfolio anyway. And that's one of the things that experienced founders keep sometimes chuckling with me about is, yeah, but you get to build a portfolio. I only have this plan A, right? And I only need to have this plan A. But even within your plan A, you can do the same thing. You can build optionality that allows you to later have certain strategic options. And if option A maybe isn't the best way, you have created option B. But the key to do that is fast discovery. So I really love founders that are able to build all this fast discovery. It makes your business so much more resilient, and it increases the long-term potential of your business if you have this muscle.
100%. I think, look, obviously with changes like we had in COVID, for example, and in the last year as well with some macro changes, a lot of firms have a lot of room to make excuses, I suppose. And I think excuse is a harsh word, but you know where I'm going, what I'm trying to say. To say, hey, for this reason or that reason, things didn't go according to plan, or this is the reason we've been going sideways. But it's just so much powerful if, instead of treating it as an opportunity make an excuse, use it to discover a new hidden superpower about either yourself or the business. And I think when the externality goes away, then you've actually become a far more valuable company all of a sudden.
Yeah. Yeah, I agree. I mean, these hardships sometimes in the great founders, by the way, that's another thing where discovery actually really helps you, being very nimble about these adversities. It allows you to become a company that before maybe you never thought about doing because your focus was on scaling what worked. But when that stops working, well, that's the force function.
Absolutely.
I also wrote, so this is from 2019. I also wrote in 2019 that I favor initial growth, not initial margins. And so I'm actually wondering live right now whether I'm still feeling that way in the year 2023, where the VC parrots say, no, it's all about margins. It's all about margins now. I would say in the early days, I would still favor the initial growth. Going back to the same argument I just made is that it allows you to discover. If you just come in with too high margins, and that bars you from actually having partners being customers, suppliers, and that would force you to have a slower discovery, then that would be a bad choice.
Yeah, I would largely agree with you. I think the caveat is to find a model where the margins are within your reach. As in, if you choose to slow down the growth, it is actually within your reach to improve margins. I think what we see in some companies is the margins are actually not within reach, but it's just growth for the sake of growth. You know what I'm saying? So it's not really a trade-off. It's not really a trade-off. It's just one is absent, and therefore the other is magnified to an extraordinary degree. And I think, but let's say if we combine the other aspect of a truly resilient company, which knows how to activate different superpowers, different aspects of either the business or the personality, I see it as sort of like a spectrum. Obviously, there are exceptional companies where for a year or two they can be highly profitable and also growing very fast. But if you take a longer period of time, I think, and you break it down into periods of 6 months or a year at a time, you probably have to, in real time, decide what matters more in that 6 month spell or that 12 months. You need to prioritize a little bit more on growth or on margins. Yeah, and I think models and companies and founders who have that ability, definitely more appealing and definitely a good recipe for construction tech, in my opinion.
So then let's stay on the topic of founders within the
Mm-hmm.
complex construction industry and the adjacent industries we're covering, being renovation, supply chain, logistics, blue collar, and 3D design and computer aided design. Within
Mm-hmm.
those markets, talking about the founders, what are like the attributes of founders that you've grown to love within our market?
Founders who know a lot, not just because of the logos that from their, either their past education or work experience, but the knowledge is revealed through a very interactive Q&A, which is very probing in nature. By contrast, what I mean is you also quite often get the knowledgeable kinds where the ego gets bruised easily. And I find that is a very, I think that persona may work in certain other kinds of industries. I think that persona sooner or later runs into huge stumbling blocks in construction tech. It may or may not manifest in fundraising right away, but I think it creates an issue with finding product market fit.
I call that the Icarus
Okay.
problem.
Uh-huh.
I wrote about, was it 21, about the comparison between, can I say the name? I guess I can, about Katera and the Icarus story.
Okay.
And for those of you who don't know the Icarus story, I may not mention it now. I think it's widely documented on Wikipedia what that means. But I think when you come with hubris, that's really a problem.
Yeah.
In construction tech, when you think you can do things better than 100 plus years of organic optimization in this industry, just because you think it's inefficient doesn't make it inefficient. There's this, sorry, I'm just sidestepping, but there's a great anecdote that that someone with a lot of his history and experience in this industry has shared with me. He said, okay, look, I mean, I can digitize the access to our yards where today people use like these little like physical cards that look like check cards to get access to our yard and get,
Okay.
through the door. I could digitize that, but that doesn't make it more efficient than actually using these cards that I put into the car and that they use. This is digitization for the sake of digitization. And so my point being, not everything that looks inefficient in construction necessarily is inefficient. And so it takes a lot of history, but also humility to figure that out. For me, that's actually another, or that's a maybe combination to another founder trait that I've seen being useful more often than not, and that is maturity, like personal maturity. You can
Yeah.
have maturity at all ages, and you can lack maturity at all ages. So I'm not correlating it necessarily with age. There might be correlation for some people, but for some others not. But it's about maturity, the ability to have meaningful conversations with customers, but also with investors, and know how to appear senior, how to talk about the right things, be to the point, listen when you need to listen. All these things that we associate with maturity, I can hardly think of an industry that requires maturity more than construction.
Yeah. I mean, I think, of course, we get to see more of it only in the post-investment phase. And if you're lucky, we get to experience it pre-investment or see samples of it. But when it happens, it's such a delight. It makes working with such founders truly enjoyable and a privilege.
Absolutely. Yeah, I agree. Hey, and I just wanted to say one more thing before we move on here, because you mentioned the logos earlier, and like, oh, I have pedigree because I have these logos. I would say the founder among all the founders that I work with that probably exemplifies best how little logos mean as a founder that actually that I work with. Amazing founder, just brilliant person, great company builder, sold their first company, worked for one of the biggest tech companies in the world for many years, came out, founded the second company. That one is going well. never even finished their studies. And the studies were at a good public school, but nothing that, you would put into the category of some of the US private schools, etc. So it really means nothing in most cases.
I would agree. Yeah.
Great.
I mean, it's saying something that we revived a discussion thread from disagreed, with me concluding by saying that I agree with you.
Yeah, I know.
All right.
I spoke the last 2 weeks with 15 M&A professionals on the buy side in the construction sector, the software sector, and 2 people that work in unicorns on the buy side, where unicorns are the buyer of other tech companies.
Yeah.
And man, that was fascinating. So I set out on this journey just because I wanted to figure out like what is broken in this M&A process. Now that M&A becomes not just more of a topic, but you actually see M&A happening, mostly mid cap, maybe small cap, not so much large cap yet. But you also, like, you and I and Adam, and we had all these like side chatter the past few months from corporate partners that we interact with every month, or that they want to buy more or acquire more. So I set out on this journey and I wanted to figure out like what is broken in this process, what prevents these people from actually doing more deals. And man, that was fascinating. I got to tell you. So let me just start with maybe the top insight. We can figure out the other ones as we go.
Yeah.
So the top insight was that corporate buyers, strategic buyers, as well as private equity buyers that are active in our industry want earlier relationships with companies. They really struggle with banker-led M&A processes. Almost uniformly, these people said, if a banker shows me the deal and that's the first time I get to build a relationship with the firm, I'm not going to do the deal. I will be not able to pay the price, not accept the risk. I will not be able to extract as much, I guess synergy would be a word, but as much like strategic value, and validate that and build that rapport with the founder to actually extract that value in such a process. So
and
that was.
Did you get a sense of when they say early, like how early are we talking?
6 months was most of the. Some said it out loud. The others, I felt like it was implied that 6 months was the minimum. But many of them seem to appreciate the opportunity to get to know these founders a lot earlier.
That actually correlates quite nicely. So just earlier this week, we had a board meeting with another of our portfolio companies. And for context, it's somewhere in between the Series A and Series B stage. And one agenda point was in wanting to acquire a company which it's like a small cap publicly listed firm, which is going through a bit of a tough time. So try to take them over. And even that was described as like in best case, if everything happens, all the hoops are clear. Best case, it was described as a 6 to 12 month process.
Oh, interesting.
Yeah.
Oh, wow.
For I guess a whole host of reasons. Yeah.
And is it also in that case where I guess the founder of our portfolio firm, he wants to build a relationship with the management team, or is that something that would be less of a topic?
So the interesting thing in this case, apparently they've already had that relationship for 2 years already, right? So in fact, in their case, the process seems to be much more involved. Just to build on what you're saying, even though they have the relationship going back 2 years, their feeling is that the process itself from now will be an additional 6 to 12 months.
Well, there you go.
Yeah.
Yeah, the people that I spoke with, and that I guess takes me to maybe one of the other large insights here. They were all saying that there's just too much going on, too much noise in the market, that for a banker-led process, a process that is supposed to, last whatever, anywhere between 4 to 8 weeks and competitive and blah, blah, blah. There's just so much noise that you're just not engaging on any of these. In fact, one M&A director at a large software firm told me, Patrick, I know all the 10 mid-market companies that I'm interested in, and I'm actively building relationships with these if I can, but I cannot always. So that was this particular person's problem, and it seemed to be something that other people felt as well. While at the same time, they were all saying, but then I get to see all this, excuse my French, all this shit noise of venture-backed businesses that raised a lot and produced very little, and that are either distressed or I get offered as a product M&A, but there's really not much product there. In fact, one person said, I will not forget this, one person said, in this noise, I have seen at least 10 generic construction project management companies in the last year being offered to me. I'm just not moving on it. There's just not the numbers, not the unit economics, burnt a lot of cash, and the product, it is nothing to write home about.
Yeah.
So this noise seems to be an issue.
I wonder also, given what seems like a divide between, I guess, what is pitched as a product synergy, but a highly bloated cost structure, a lot of it also comes down to figuring out, hey, what do we do to get rid of these bloated costs? Like, is it going to be easy to, and I'm sorry, I have to put it this way, fire all these excess resources who are not adding value? And that also makes it a very convoluted and involved discussion.
There was this other, so to the point of team and resources. So two aspects about the relationship and the mindset of the founders that potentially want to enter into an M&A process. One, I had one person working for a strategic on the buy side say the best, and this strategic has done a lot of M&A. The best indicator whether they move ahead with a startup acquisition is if in the first meeting, the founders tell this strategic why they think the strategic is the best owner. And I said to this person, hold on, why is that a predictor of whether you go ahead with a deal or not? You know anyway, if you're a good owner or not, whether that person says it doesn't change anything for you. He said, it's not about us knowing it, it's about him knowing it or her knowing it. And actually that tells us whether they want this deal or not. So that was really fascinating. And the other one about founders was, this was an example given on an acqui-hire, super deep tech company in construction tech, accomplished tech founders. And that person was saying, hey, I've seen different post-merger integration issues with culture, like different logo, and now I need to approve travel expenses. All that is tough. But like these people came with money from top tier VCs, they just couldn't take it off the ground, and they burned like a lot of money. And when they came here, it was painful to actually make them want to build profitably. And so that seems to have been, so this person at least would want to look again whether a founder can actually have that mindset shift.
Interesting, right? Because I think in what we've been taught, and I guess VCs in general are part of the problem here as well, that it's also not fashionable, at least for a top tier founder, to come out and say, hey, you are the right acquirer for me, and you're kind of revealing all your cards, and that's not how to play the game, etc., etc. What do you think of that, and how that overlaps with what you just said?
Well, I mean, based on these learnings, it seems to make a deal more likely. When you think about it, it doesn't close down any other options. I mean, what you tell that person, I would always encourage people to be authentic, but in the end, it's everyone's choice what they want to say. But it makes sense to me. I mean, if it's not so dissimilar from how when we do deals, right? I mean, sometimes you just feel that chemistry with a person and you feel like we want to be partners, like that person wants to be a partner with us and vice versa. It is making deals more likely.
Yeah, I hear you. Yeah.
So,
nice.
But I think a few really, really interesting learnings. And Oh yeah, the before I forget, the sweet spot that everyone seems to be striving for is these 100 million to 300 million acquisitions on the buy side, I should say. Like that's the sweet spot where buyers on the buy side want to be.
Is there any science or method to that number, you think?
Maybe it's more a reflection of most of the acquirer sizes in construction. I guess if you talk to some of the very, very few maybe software companies that have super large revenues, like billion-dollar revenues, maybe they would provide a different answer. I have a feeling not necessarily if I look at their past acquisition behavior. And construction, I mean, construction just yields way more mid-sized companies than super large companies. So it could just be a reflection of that.
Yeah, that's true. Yeah.
No. But if a founder is on a plateau and you want to prepare yourself for M&A, give it time, allow people to build a relationship with you. Don't necessarily think the banker process is the best process.
Yeah, I would have to agree. Yeah. All right.
So maybe pivoting from here to what's going on in the VC market. This was M&A, but what about VC market? What are you seeing?
I see things moving in certain aspects in slow motion. Unfortunately, I'm not that active in AI, if you've noticed, right? Sometimes I wish I was, just to, be, more closely involved with some of my VC friends. I think once you are outside the AI, I was going to say AI bubble, but let me just say AI sphere, just to be, I guess, more politically correct.
Oh, someone had an A in geometry.
So let's go with AI sphere. So now that I'm outside the AI sphere, I feel like there's a bit of thawing happening ever so slightly. So it felt like for quite some time, there was some action on the seed, pre-series A, pre-series A rounds, the earliest rounds. And it was like a complete zombie zone from Series B onwards. Like, it doesn't matter how good of a company you are. It doesn't matter what's the deal. It's like everyone's like disappeared off the face of the earth. Yeah. Like, so, which felt super weird. It feels like things are opening up, mind you, really slowly, like really slowly, right? I have to say, it feels to me like in many models, in many markets, the sort of generic sentiment of lumping together high quality companies with poor companies is boiled down to, very, very cheap discounts or low willingness to pay, I should say, in terms of new rounds. I think to the point where it's massively overcorrected against the best firms. I don't know what is the catalyst which starts like a new revival.
I mean, on that catalyst question, I think the latest catalyst that we could have, if it takes that long, is one super large IPO. I think that unlocks everything. I don't think it will take until then. And in fact, so me operating mostly Europe plus LATAM, but mostly Europe, I think this is the first time in 15 years of being in this industry that Europe pays more crazy pre-seed and seed valuations than the US.
Yeah.
15 years. Never happened. In fact, you had European founders move to the US exactly for the reason of valuation arbitrage.
Yeah.
Right now, you would have to move the other way. Like, that's how crazy it is. So,
any hypothesis why that's the situation right now in Europe?
I mean, it's counterintuitive to the degree that actually US VCs are not particularly active in Europe. If you take out the batshit crazy AI stuff, sorry. But other than that, US VCs aren't really active on the continent for the last 18 months, and certainly not pre-seed or seed. So you would expect that to drive valuations, but that's not it. Hypotheses, but unvalidatable, is that European VCs still have a lot of dry powder, and last year was slow. So maybe this is now the time when they feel like they gotta be active. It's a simplistic explanation, but there is psychology in our business.
I mean, now that you mention it, and I think we had briefly chatted about this a few episodes earlier, might have even been one of our first 2 or 3. There are still these odd examples I see, which again, I think always baffles me. So suddenly out of the blue, you'll have these examples of like a 4 million pre-seed round, 5 million pre-seed round, just because it sort of fits the description of something which is in flavor right now. Always, I guess it always raises the question in my mind, will that be the next, will that be the company which sort of suffers in the next fundraising cycle for whatever reason? Yeah, it's a bit odd where we find ourselves right now in the VC cycle.
See, that's the thing, right? I mean, long term things converge towards the fundamentals. It's always the same thing. Even if you think you're in an eternal upcycle of cheap money, ultimately fundamentals catch up. Sometimes it takes 10 years, but they do catch up. And sometimes you can be lucky selling earlier than that and making someone else your bag holder, which happened a lot with IPOs in 2020 and 2021.
Yeah.
Ultimately, the fundamentals catch up. And so what are those fundamentals about startups? Well, always starts with differentiated product. Usually it should contain some form of efficient distribution and scalable distribution. And then finally, that should express itself in pretty great margins and strong cash flow. Even if people forget that, you should be backing early stage businesses that have these fundamentals.
Yeah. I mean, I can't help but think that all this is a setup for suddenly money rushing in much faster than it should at some point of time in the future.
Oh, you think that's happening again?
I think so. I mean, in my opinion, I think it will have to happen. So we are now in one extreme of the overcorrection, or what seems like an extreme overcorrection. I think then we will correct against this overcorrection in an extreme way.
That's that's an argument I can understand. Not sure I share it, but I get it. Kind of aligns with what some of the more wild economists out there, not necessarily the mainstream economists, but the more wild economists call like the dollar milkshake theory. I'm not going to, again, Wikipedia it, but basically means that quantitative tightening post such a low interest environment and quantitative easing that we've had can only last for so long until you have to quantitative easing again. And then you're just increasing the problem almost like a tornado, like a vacuum, or like a black hole. And so these people believe what you're believing is that, quantitative tightening, that thing will be over soon, and then it will be QE again.
I also think because of how VC operates as a business, right? All it takes is for some backers, some investors to think, hey, we've been sitting on the sidelines for too long. And in the meantime, hey, there's this couple of cool companies we wish we had done at bargain prices. And that then starts like a new frenzy.
You mean because they are available at more reasonable valuations? Is that the point?
They were available at reasonable prices. And at that point, no one moved in. So it creates, it's another version of the former.
I see. Have you seen examples of that recently?
So not playing out in real time, but I think there's a case to be made for a version of that played out in 2021. I think just everyone felt that, hey, I saw this other company the other day and that suddenly had a new round. So I need to now get in either at a more expensive round or some competitor or back this other company because I saw this other company and I missed out. And I could have backed it at a low valuation.
In the current environment, that's the psychology of bottoming out, right? So if a large enough group of investors just think that we've reached bottom, that's the point in time when people start buying. That's the common psychology around here.
What is missing, I suppose, is a few or a critical mass of firms creating that regret out of this cycle. I think once you have that, I think that could be the beginning of a new buying cycle.
Now, the thing that no one knows, though, is how the IPO market will look in 7 to 10 years, right? I mean, it's so many VC investors. I mean, I really sometimes, okay, let me not say that, but like there's really this short-sightedness of, hey, next year I'm going to have this IPO. Dude, that's not your market. That's the bet you should have made 7 years ago, and that should be in your portfolio.
Yeah.
Your market is the IPO market in 7 years.
Yeah.
And that's why you should be investing today. I mean, but that is hard to predict. But that, even if it's hard to predict, that needs to be my perspective.
Yeah, absolutely.
So I have no idea how that's going to look. Just so much macro in between that can change.
Yeah.
Just let's not talk about this, but just to throw this out there, Taiwan.
Yeah. Yes.
Right?
Yeah.
No clue. What happens with Africa? Africa is a vibrant market. We talked about it.
Yeah.
So, well, one thing I know for sure is this world keeps printing money.
I mean, there's
only one way.
I mean, we are stuck in this situation, right? If you don't do that, you have to face a much more hideous problem today. Why deal with that when you could, pass on that problem to the future?
That's it. Yeah. That's it. And it's always the small persons that suffer the most from that.
Yeah. Yeah.
So, look, I think for founders, the best advice that I can think of in the current VC market. Actually, I want to give an example. So, one of the companies I'm currently having deeper conversations about a potential deal with is a company that has insanely good sales efficiency. Like if you look at their sales engine and you run all the different SaaS metrics that you can run, the sales efficiency is very good. Has a few gears that really need optimization in that sales engine, but end to end, it's very, very good. At the same time, not very good overhead efficiency, not very good burn efficiency. And so this is a business that there's always different ways to glory. One of the ways to glory that this business could take is just becoming default profitable, because they have a product that works. They have a motion that works. Why do you keep all that overhead? And why do you not think about getting rid of a part of the overhead to prove that you can be net profitable? Your negotiation position becomes so much stronger if that's what you do in the current VC environment. Not just that, you're actually the asset that people are looking for in this market, is profitable, is proven motion. So that to me is actually an asset that, I think in this case, the founders have not fully understood their position yet.
Interesting. I think that could also be like a wild card, which maybe changes things. There is an emerging cohort of profitable companies. I mean, interestingly, emerging in many different parts of the world, actually, as we speak. I think all it takes is for some of those to, because they're in control of their destiny, to just fast track maybe one round a little bit faster than they thought. I think that could create a bit of regret in the market, is my suspicion.
And then you think there could be money piling in subsequent rounds fairly quickly.
Yeah. Ironically, in companies where the promise is of profitability, but you know how this cycle plays out. It's like it's a never-ending cycle.
But you know what? That takes me to a different, or to yet another baffling thing in the current VC environment. So 2018 to 2021, founders didn't need any fundraising advice from their investors. the fundraising was done by the market, not by the founders. I mean, sorry, founders, I have to break it to you, but if you raised a lot of money in 2020, that's not because you were so great. So let's be real. In the current market, I more often than not get baffled how few founders actually use the competence of their VC investors about the topic of fundraising. Like you're having people as your partners that whose only like repetitive things that they do is looking at different companies, spotting patterns, being good at macro, and doing fundraising. And so I would say half of the firms that I get to work with come to me actively to help them shape how they do fundraising, and the other half I have to trigger. And that baffles me, because that's just a wasted competency in a market that actually needs fundraising competence.
I agree. And something tells me it will get worse before it gets better, in the sense the funding deficit will become more intense, and therefore the need for someone to offer highly specific coaching or guidance, and sometimes all it takes is someone to help break a tie, so to speak, or break a stalemate, and you're done. That's all it takes. Sometimes it's not rocket science where you're like stitching together terms and something much more complex than that. You just need a stalemate breaker. That's it.
That's a good point. It really is, because markets are psychology. You can talk to as many microeconomists as you want and take as many micro classes as you want and do your curves and whatever. I can tell you it's psychology. It really is. Like whether demand moves, whether supply moves, everything is psychology. And by the way, that's what hedge fund people will tell you.
Oh, interesting.
I mean, large hedge funds actually have teams of psychologists.
I did not know that, but now that I think about how some of them operate, it makes all the sense in the world.
Yeah. So fundraising in the current market is a lot of psychology, and you should be using actually the competence that is around you. One of the bigger mistakes I've seen founders do is actually go to angels for fundraising advice. Not saying there aren't great ones, there absolutely are, but there's a vast majority of angels that actually have never done fundraising in difficult markets, organize fundraisings with the right process, the right narratives. Oftentimes you get like these, shallow wisdoms, but then they are really dangerous in this market environment. And so my advice to my portfolio founders is like really try to figure out which of your angels knows what they're doing in that regard.
100%.
So, but overall, it sounds like you think it will be better soon.
I think it'll get. Let's go with that. I think we'll also have some more skeletons come up with and reveal some more distressing news. But after that, I think because everything gets reported with a lag. I think in real time, I think things are getting slightly better. But the news cycle will seem like it's getting worse.
I mean, I visualize it like this, right? So if this is the down market and this is the starting up market, again, so it's not sequential. Actually, and that is because the people who are investing in the up market already have the bad news here. It's just the news gets it later.
And the news, and fair to them, I mean, they also reported a ton of these funding rounds. The news obviously loves negative stuff as well. That also makes for fun reading.
Oh yeah. So you think this next half year there will be a lot of reporting about like bodies in the closet?
I think so. I think so.
Okay. I'm getting my popcorn ready.
I think so.
Which part of the world do you think that will be the most?
Frankly, all of them, man. All of them. I don't think there's any. So look, all markets have got a lot of money. The easy thing for me to say would be, hey, it would be in the proportion of the amount of money they raised in 2021 in the relative ratios, I mean. but I think to make it more simple, I think all the major markets will have their fair share of bad news. These overinflated companies, all of a sudden going belly up, in some aspects looking like horribly quick deaths at the end. Yeah, but I think it'll maybe overshadow a more positive aspect to the turn in the market. But that's okay. That's how market cycles are.
It's difficult to quantify, but maybe just, I don't know, proportionally to the size of the market, I think LATAM will, just to that proportion, I think the LATAM startup market will maybe yield a higher proportion of bad news.
I mean, I don't know if we've probably not done this, and I'm sure many media publications have. I think if you were to chart the total VC funding in 2021 and how much that contracted in 2022 and 2023 year to date, yeah, I think of the major regions, I think LATAM would be my guess on the region that has contracted the most. Not saying that of course is a single metric to determine market quality or readiness or anything of that sort, but I guess it is one variable that indicates the degree to which the bubble is inflated.
Exactly, and that contraction hurts the most in the subsequent stages, and I think LATAM unfortunately has seen a lot of investor retraction, which at that stages came exclusively from the US. China investors weren't really active in Latin America yet in the growth stages, which could change. And then you don't really have as liquid an exit environment as some of the other markets just yet.
Yeah.
So, I mean, never a dull day.
Oh, absolutely. I'm looking forward to what the next 6 months looks like, because I think as you described, it's an interesting overlap of cycles, or the cycle shifting over, which I think it's a very fun time to be investing.
I agree. And I keep telling founders, like, it's a cliche. In this case, fortunately, it's true. I can't think of a better time to build a business over the last 10 years. Right now, the world really is your oyster. There's so much less competition in interesting spaces in construction tech, supply chain, renovation, 3D, than there ever used to be. Because when you founded in 2018, there was like 12 different founding teams that got money to build the same thing. Now, not the case. Except, unfortunately, you're buying GPUs to build the next LLM.
Yeah.
But other than that, I think it's a great time to be building.
Absolutely.
Speaking about things you're looking forward to, what are you looking forward to in your calendar for next week?
I mean, so we've been speaking about skilling and upskilling across several episodes. There's one interesting theme that it's now on my desk, and I'm working through it as a theme, and there's more than one opportunity of applying the upskilling concept, not to people, but to facilities and manufacturing units.
Okay.
Right. So to kind of enhance their appeal or their marketability, their income generation potential. And that entails, again, various combination of products, services, etc., which I find quite appealing. As you can imagine, especially for export-oriented products and export-oriented markets.
Wow, that's intriguing. I want to ask you next week more about that. I'm going to make a mental note here. I think that deserves even more specification. That maybe deserves a spot on the show next week. Yeah.
I think I'll use the next week to really dig into it.
Okay, let's do that. Here on my calendar, I'm having actually a fundraising discussion with one of my favorite young companies in the insulation space. Insulation, nice. If you're not from Europe, like that's a hot space. Pun, I guess, intended. And winter's coming,
Oh yeah, that's right.
So so these founders asked for some support, how to craft narrative and think about the business early on for the next race. I'm looking forward to that. It's gonna be fun. Two really good founders.
Awesome.
Cool. So I guess next week we'll discuss about this mysterious company then.
We will. Yeah. Absolutely.
Good. Well, until then, I hope to not see you.
That sounds like a terrific resolution to me.
Nice. You got your weekly dose.
I did. That's all I can handle.
All right. Well, then let's cut this off quickly.
Sounds like a plan to me.
All right, sir. See you next week.
See ya. Bye-bye.